I'm going to show you the truth about velocity banking and paying off a credit card. Does it work? Well, I'm going to show you exactly how the method works and what the outcome is. And I'm going to show you this particular video here. I like what they do. They have, I think, the same belief system I do, that banks aren't on your side, government's not on your side, let's not give all our money to banks. But they have some somewhat confusing parts to the video, and I just want to point them out so you understand how it does and doesn't work. So if you have credit card debt and you're tired of giving all that money to the banks, unbelievable amounts of interest, I'm going to show you how to stop that. And then after I explain the velocity method, I'll also give you some alternative methods because I have multiple videos and it really depends on your situation. What kind of loan do you have? What percentage rate do you have? What type of terms do you have? Is it credit card? Is it a personal loan? Is it a mortgage? It really depends. But first, take a look at my channel.
So take a look at the playlist page for Hack Your Finances. You can obviously subscribe at the top. Playlists to get out of debt, credit cards to use to your advantage, and investing for passive income. At the bottom, we've got a 6-lesson series to help you get out of debt. Thanks for watching and supporting the channel.
So if you like this video, I'd always appreciate a like and some comments below if you've got comments on the video itself. So in the example that they give, they talk about the person has an income of $3,000 a month going into their bank account. Their expenses are also $3,000 a month. So they say that their cash flow is $0. I'm not sure what they mean by cash flow, but basically they mean the person doesn't have anything left at the end of the month. Okay? Plenty of people in that position. And they say there's a $10,000 credit card at 21%. And it requires a $400 a month payment. Okay, now first off, they're not clear in the example as to whether or not the $400 payment is being satisfied in their expenses. In other words, do they have $2,600 in expenses like rent, clothes, food, gas, etc., and $400 for a payment? Or do they have $3,000 in rent, gas, food, clothes, etc., and they don't have the money for the $400? They're not clear. So I'm going to show you the situation where they do and where they don't, and what it means for the method itself. All right, so they point out that of the $3,000, they do say that $1,000 is for rent. Why do they point that out? Well, they point that out because typically you can't use a credit card to pay your rent without paying additional fees. So there's about $2,000 that you could use in your expenses. You could pay them with a credit card, and I'll show you why that matters. So I'm going to use a simpler example. Instead of a $10,000 credit card balance, I'm using a $4,000 balance. Here is the velocity method. This is what you do. In this example, you might be paying your expenses every month by using your bank check card or debit card or cash. Whatever it is, you have the money from your income to pay your expenses. So what you do is you take your income, and instead of using it to pay your gas and your groceries, you take the income and you put it onto your credit card. You make a payment with all of your income. Then you use your credit card to make your expenses. You're not increasing your balance, you're just making your payments. But I'll show you why that matters. So how much did they put down? Well, they said, all right, out of the $3,000 in income, $1,000 has to go to rent. You can't use a credit card for that. So there's another $2,000, 3,000 minus 1 leaves $2,000, that you can move on to the credit card. So, $4,000 balance in this example, you move the $2,000 onto the credit card, you make a payment, and now you've reduced your balance from $4,000 to $2,000. Okay, now the obvious is, well, great, if I move the $2,000, how do I make my payments? I have expenses. Yes. So you're going to use the credit card now to pay your expenses. So the expenses in this example is $1,000 for rent and $2,000 for other things. This is the example A, where the $400 is not included in that $3,000. They're saying the person doesn't have the money to make it. Okay. So you've taken your $2,000 of your income and you've moved it to the credit card. You now have a smaller balance. Then you're going to pay your expenses. So your expenses are $2,000. So you're going to increase by $2,000. You're going to be left with $4,000. So this is not a huge impact. But what is the impact? Well, if you didn't move the money over and your balance stayed at $4,000, your interest at the end of the month, and I have a video showing how to calculate credit card interest, but I already did the math, it's $69. But by lowering your balance, let's say at the beginning of the month, all your income was moved over, this $2,000, then your balance is $2,000. They calculate based on your average daily balance. So over the course of the month, if you had a $2,000 balance instead of a $4,000, interest would be calculated on the 2, not the 4. But we know that even though we decreased it to $2,000, over time, we added $2,000 to make it 4. So I'm just going to say during the month, the average daily balance was $3,000. We'll split the difference. In that case, it would be $52 in interest. So what are you saving? Well, by using this method of moving your income on and paying your expenses with your credit card, you would have saved $17 in interest. Take that. It's costing you $52 on the $3,000. So you take your $52 in interest, you add it to your $4,000, you're at $4,052. Okay. Did you decrease your credit card balance? No. Did you pay less in interest? Yes. Not much, but you did pay less. So I'm guessing that in their example, they're considering the $400 to be in the expenses, and I'm going to show you that in a moment. But they say two things. They say here, does it satisfy, got my colored markers, does it satisfy the payment? So you owe $400. You don't have the $400 in this example. So by moving the $2,000, you've satisfied the payment because the bank says $400 should appear. $2,000 appears. They go, oh, $2,000 is more than $400. Okay, payment satisfied. Does it lower by $4,000? Well, let's see what you did. You put $2,000, you decrease your balance by $2,000, and then you spent $2,000. Okay, so decreased it to 2, added 2, 4. Did you decrease your balance by $400? No, you didn't. Okay, so now let's look at the example of the assumption that the $400 is in the expenses. Okay, so here we go. In the first example, we said that person's video was saying that the $400 payment, they didn't have the money for. They had no money for the payment. Okay, and what would that do? And you saw what that would do. That doesn't make a lot of sense. It's really not getting you anywhere. So we're going to assume that what they meant was the $400 is in this $3,000 expenses. So they have $2,600 in whatever they spend, and $400 of it is the payment. Okay, that would make more sense. So using the same example, you've got your $4,000 balance. You take your $2,000 that you have in your income, and you move it to the credit card. You've reduced it to $2,000. During the course of the month, you pay your expenses. Okay, so of the $2,000, the expenses, $400 of it is designated for the credit card, and $1,600 is other stuff. So what does that mean? That means that you moved the $2,000 in income, but you only increased your expenses by $1,600, right? Because out of the $2,000, $400 is meant to be left there as a payment. So if you're only increasing by $1,600, now you're making progress, you're at $3,600. Before we were stuck at $4,000. Okay. Again, what does the velocity method say? Well, the higher balance is higher interest. So I'm going to take an average of during the month because you paid it down by 2, but you only added $1,600. So let's say the average over the course of the month was about $2,800. Using the velocity method, that's $49 in interest. So you're saving $20 in interest. But what happened here? Well, you paid it down by $2,000. You only spent $1,600. Therefore, your balance is now $3,600 at the end of the month. Add your $49 in interest, and you're at $3,649. So you've decreased from $4,000 to $3,649. Now this makes more sense, right? If the $400 is included in the expenses. So does this satisfy the payment, the method of moving the income over and then using it for expenses? Yeah. Payment was $400. You put $2,000 into it, satisfies the payment, just like the previous example. Does it reduce it by $400? Well, yeah, it does, because in your $2,000 expenses, you've accounted for $400. So this method makes more sense. But as you can see, the velocity method is saving you, in this example, $20 a month. $20 less in interest by just moving the money over. Not a huge difference. If you had just made your $400 payment and forgot moving money, paying expenses, and doing all of this, all you did was say, okay, I'm going to put $400 payment to my credit card. Well, yeah, you're going to pay a little more in interest, but it's not a huge difference. So it really depends on how much you want to go through. All right, now I'm going to show you some alternative methods to paying this down. All right, so I wrote up some alternative examples to how you could pay down your card. I've got many videos on this, so subscribe to the channel if you want to see more and take a look at the channel page. It goes through all the different types of videos. Always appreciate a like and subscribe. All right, so you've got $4,000 balance. We're just going to use that on these 3 examples. Example 1 is simply just your credit card and you're making your payments. Example 2 is a balance transfer card. Example 3 is a personal loan. Let me explain. So if you have $4,000 and you're making a $400 monthly payment, it's a pretty high payment, and the card is 21%, just using it from that past example. Card rates these days, I think on average at the time of this video is about 24%. But regardless, I put the months in green and the interest in red. Interest is in red because we don't like interest. So the months, it's going to take you 12 months to pay this off if you're just making that payment. And the total interest will be $435. So you'll pay a total of $4,435. Okay. What if you took that and you moved it on this card, this credit card at 21%, and used a balance transfer and you moved it to another card? And that card was a 0%. I've got a video on a lot of 0% balance transfer cards. 12 months, 15 months, 18 months, and I believe the most is 21 months. And now what this doesn't count for is the fact that they usually charge you a fee. So your balance here might go up to, let's say, $4,300, or actually it's about 3 to 5%. So it might be around like $200 or less. 0%, you make your $400 monthly payment. It's going to take you 10 months, less time. You're going to pay 0 in interest. Now you will have to pay that transfer fee. So the 0% balance transfer is obviously it's effective no matter what. You're going to pay less interest. But the higher your balance, usually the bigger the disparity in the interest. So you're still going to have a little bit of extra payment. Let's say, well, it's $200 because of the transfer fee. Now, another option is to get a personal loan. Very common when people want to consolidate multiple cards. Consolidate meaning you got card 1, you got 2, you got 3. You take all the balances, you add them together, and you get a loan to pay all 3 off. They're all gone, and now you're stuck with a loan. But in this example, we're just going to say we get a personal loan for $4,000. It's roughly on average about 12%. Your payment would drop. It would be a fixed payment of $355 a month. I used just a 12-month term. You would pay an interest $265. So just using the regular method, you're at $435. Balance transfer, it's going to be you're just going to pay that balance transfer fee because there's no interest. And then personal loan is actually going to be less. Now the difference between this method here, personal loan, let's call that method 3. 1 and 2 are both on credit cards. Credit cards are considered revolving debt on your credit card on your credit score. So you can, by paying this off using a personal loan, you no longer have that credit card debt. You now have what they call an installment loan, which shows up in a different section of your credit report. So that can help you as well to get rid of that revolving debt. Because if you've got a balance of $4,000, you have $4,000 credit available on your credit card, and you've paid it off, so your balance is 0, then you have a 0% what they call utilization rate. You're not using any of your credit. So credit card or the credit score, Experian, TransUnion, they all want to see what your utilization rate is, right? The lower the better. I think it's best to be under, let's say, 15% or so. If your balance was $1,000, well, that would be a 25% utilization rate, right? 1/4. So it gives you an idea. But if you are able to pay it off with a loan, then you're now going to have a 0% utilization rate. That's going to help your credit score. And you're going to have an installment loan. And as long as you're making your payments with the amount you're obligated to make, and you're making them every month, that's going to help your credit score as well. So I hope this made sense, and it explained simplistically the velocity banking method and pointed out just some little confusion in that other video. Gave you an idea. Yes, it pays off a little better because there's less interest because you're lowering that balance. Essentially, if someone says, what is the velocity method? It's the method of lowering the balance in big chunks, whether it be a mortgage with a line of credit or a credit card with your income. And then that balance is substantially lower in a faster period of time so that the interest calculated is lower. That's what it comes down to. It comes down to lowering the amount of interest paid as fast as possible, which makes sense because whether it be a credit card interest or a mortgage interest, it's substantial. I mean, that is 10% of your balance just in interest. And if this was more and this was more, your interest would be astronomical. I've seen some ridiculous amounts. This is a high monthly payment. On a $4,000 balance, it may only be $200, and then this would take a lot more time and a lot higher interest. Anyway, thank you for watching. I hope this is helpful. Take a look at all my other videos, and I always appreciate comments on whether or not you think I explained it well or I missed anything. Thanks for watching.